You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivastava Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey everyone, welcome back to another episode of Market Champions. Today I've got Vishaal Bhuyan, who's the CEO and founder of Aanika Biosciences. Previously used to be a portfolio manager at a couple of big names, and he's the author of a really interesting book on investing called The Esoteric Investor, where he talks about some very interesting investments and investment theses, like investing in water, trading fish in Japan, and trading mortality risk. And it's going to be very interesting to cover some of those themes. And, thank you so much for being on the podcast, Vishaal. It's great to have you.
Hey, thanks so much. And thank you for having me on. I love your podcast and excited to delve into these things.
Absolutely. So Vishaal, before we get started on some of the market stuff, could you sort of give the audience an overview of your background, your journey on Wall Street, and how you got to founding Aanika Biosciences?
Yeah, sure. So I actually started my career. I thought I was going to be a doctor. Ended up as a trader, commodities trader, first for a big trader on the NYMEX. This was right before the credit crisis, and I got very involved into these sort of esoteric derivatives, everything ranging from insurance-linked securities to catastrophe bonds, to mortality risk, longevity risk, and just that really captivated my sort of imagination in the finance world. And how do we link things that are happening in the real world to these financial, very tangible financial risks, and how do we mitigate those risks? And so that I spent, pretty much the better part of a decade working at a couple different hedge funds. One was sort of a pool of family office capital, using everything from creating our own derivatives to credit default swaps, interest rate swaps, to hedge these various risks for various parties. And so then moving towards 2016, 2017, I started looking at what are the big, to this same sort of theme, what are the big trends of the next 10, 20 years? And all of my pointers were looking at, this thing called synthetic biology. I sort of just stumbled upon it, but it was the basic concept that biotechnology will be outside of the pharmaceutical realm, right? So how do we apply biology to crops and to seafood and to all the different topics that I've always been fascinated with, to the natural world around us? And how do we engineer this world and improve it, essentially, from my thesis, to protect against things like climate volatility? And that was really, and the founding of Aanika was really the culmination of like that 10-year experience looking at both the world around us and financial instruments. In a weird way, it probably makes more sense in my head than it does out loud. But
yep. And so what actually got you in? So how did you actually find your way into? So you said you were a commodity trader, and you ended up trading some, I guess, more esoteric, to use the title of your book, market. So how did you actually find your way into it? And is that mostly like OTC, reserved?
Yeah, at the time it was all OTC. I think like CDS and stuff now is a little bit electronic, but at the time, even the NYMEX, like commodity futures, were traded in the pit. So,
right.
If you think about commodities, right, what impacts commodities? It's weather, right? So, it's not a huge push to think about, the way it was sort of being looked at was, okay, you've got weather risk. That sort of my pathway was, okay, you've got these huge weather, these huge weather events, and then, okay, like who protects against these things, right? It's insurance companies. Where do they do with their risk? Who's warehousing their risk? It's reinsurance companies. There are these things called catastrophe bonds. So basically what you have are groups of hedge funds pooling capital together to warehouse some risk for insurance companies. And they act as their own sort of independent insurance vehicles. A lot of them are domiciled, in Bermuda and stuff. And they've got their own yield. So it's literally like a bond. And you've got various parameters, whether the hurricane is going to be, a certain level or there's certain damage. And all of that is constructed to diversify the risk of an insurance carrier, right? So actually, Michael Lewis wrote a great article about this back then. I think it was called like Nature's Casino. But you're not actually gambling on it. You're really actually protecting insurance companies. But it's an entertaining article. But what an easy way to think about this is, if you're an insurance company insuring all of the homes in Florida, let's say, guess what? Like, everyone who comes to you for a policy is probably going to need a payout, right? And that's against the sort of business model of an insurance company who has to diversify across like a very broad set of, a broad spectrum, so it doesn't get that windfall liability. So what they'll do is offset that through reinsurance vehicles or catastrophe bonds. And so when you looked at the commodities markets, that just captivated me, that there's this sort of multi-layer approach at risk. And again, this is not like mortgage default risk, which is what everyone else was looking at back then. This was, Hurricane Katrina risk. And I found it really fascinating that, I think in finance too, you get a lot of things where what's the point of that? The credit crisis was a great example, right? Right after the credit crisis, like, Wall Street was like getting blamed for everything. But then you don't really see the inner workings of how important these financial markets are, because like things couldn't operate otherwise, and so that's what really captivated my imagination in terms of just how fascinated I was when it came to this risk management approach of using derivatives and bonds and stuff to diversify some of this.
Yep. And your first big theme that you discussed in your book was talking about mortality risk markets and demographics. So could you sort of discuss, number one, the demographic theme? So pretty much what's going on is aging demographics, and how exactly you use mortality. What are mortality risk markets? How do they work? And how you actually use them to sort of play.
Sure. Yeah. So once I got into this idea that everything is a risk that can be quantified to a certain extent, not perfectly, but like you can think about it in a sort of a you can put a price on it and put a number on it, and you can figure out how big this problem is based on the insurance protection. I really just went down a wormhole in terms of like, okay, well, what else is interesting in this space, right? Like, what else is being done? And at the time, one of the things that I really came across that was fascinating was that the idea that as a society, as humans, we're just living longer, right? We're healthier, we have better access to healthcare. The emerging markets, back then, again, emerging markets were a massive theme. What happens when countries come out of poverty? They live longer. So what does that mean to things like your pension? Like, what does it mean to institutions that actually are structured around the fact that like you'll probably die at 70, when really we're going to start dying in our late 80s?
Yep. And
so when you talk about firstly longevity risk, which is the entire pension system, Social Security, and all of this is geared for 65-year-old retirees, which now a 65-year-old, like if you see a 65-year-old at the gym, he's putting up like 200 pounds. It doesn't make sense, right? Like, exactly. My co-founder, she's in her late 60s, or she'll kill me. She's gonna kill me, but she can never hear this. But she just hiked the Grand Canyon, for Christ's sake. You know what I mean? So it's just a different world. So what does that mean? Is that we're gonna have a pension crisis. The pension crisis is going to be massive. By some estimates, I've looked at the numbers as, I think by 2050, it's an estimated $400 trillion of pension shortfall globally.
Wow.
And in 2017, I think that number was like, again, I'm going off the top of my head here, but 15 trillion or 10 trillion. Like, we're talking about massive numbers, a shortfall of like 5 to 7% a year. And then you couple that with negative interest rates, essentially, no yield, zero yield anywhere. I mean, the numbers just add up to a massive pension crisis. You look at, and then a slowing birth rate globally, right? At least in the developed world. And so you've got this idea of both longevity and mortality risk, which is, so the longevity risk part of it is, okay, if we live longer, that's by the way, that's a net good thing, right? We should be living longer and healthier, but our system is not necessarily like structured for it or prepared for it. So what do you do if you're an insurance company? What do you do, or you're a life insurance company? So if you're in a pension, what do you do if you're paying out for an extra 15 years you didn't calculate for, but you're also not generating enough on your capital base to make those payments? Yeah. Right? Like, it's a really bad situation. And by the way, our entire financial system is sort of built on top of that. And then if you look at the mortality risk side, you can have a situation where, it's kind of in reverse, right? So if you think about the people who, and there are like building markets of this, who are trying to hedge that, and this is kind of screwed up, but it is what it is. They're not betting that people will die sooner. They're just providing the other side of that bet, right? Like, they're providing liquidity. Think about it that way. Mm-hmm. And so if you're providing liquidity, the longer your portfolio lives, the better. So how do you offset the risk of, let's say, a disease outbreak? And honestly, this conversation probably would have sounded much more ridiculous, like, I don't know, a few years ago. But, now, in the context with the backdrop of COVID, you can see that outbreaks can happen, right? Things can happen. So there are these markets that are developing, and I think they have to develop to make sense of some of these things that are they're just numerical facts, right? A pension shortfall is a numerical fact. So that's sort of how I morphed into both looking at, natural catastrophes and insurance risk and longevity risk and mortality risk, but it's really all the same lens, right? You've got these really big, impactful risks that need to be priced and need to be diversified. Same with water. We're talking about water shortages. And what's interesting about this is that, at the time that my book came out, it was somewhat novel, but now water futures actually do trade in California, I believe. So, I mean, we really are moving to these structures to diversify.
Yep. And so how exactly do you go about trading longevity and mortality risk? So could you sort of talk about, I guess from a trade construction standpoint, how you did it as a professional portfolio manager, but at the same time, how would sort of an average investor, be able to play that sort of theme?
So most of these were OTC. So that's probably going to be out of touch mostly for the average retail investor. So a lot of times what you had were, so Goldman tried to, I don't know if it still exists, but Goldman at one point put an index out, and it was a longevity index. And what they were trying to benchmark was like the average life expectancy. And you could buy a bond of some sort that it was more of a swap, actually. And you could basically you could be the fixed payer or the fixed receiver, depending on your portfolio. Sort of like, so, you've got a portfolio, let's say, whatever, it's some sort of instrument. And if the general population of that cohort outlived a certain parameter, then you're the receiver of the swap, and vice versa. So a lot of this comes down to, and I know your audience is probably more looking for what ETFs and stuff like that.
No, go ahead and explain sort of the swap trade as well. So.
Okay, yeah, exactly. So it's all similar to that. So everything was very OTC. And look, that's one of the problems with all of this. is that it's very complicated and very they're very complicated and they're very illiquid, was another big problem, right? So the only people who are really playing in these markets were like insurers, reinsurers, big hedge funds, specialty funds kind of thing. Because it took a lot of, not everyone's got, access to their personal actuary or whatever.
Yep.
So it's like, they're very complex. Another way people were looking at this though was buying life insurance policies. So if you think of, and these still happen, they're called life settlements. And so you've got, let's say, a bunch of people, call them 500 people want to sell their life insurance policies, or maybe it's one person with like a $10 million life insurance policy. You'll actually have investors who will give you, whatever, the net present value to a certain extent of your face value of your life insurance policy. Let's say you've got a $10 million policy. It's like, we'll give you $6 million today and we'll take over the premium payments. And when you pass away, we collect the $10 million. And that sounds maybe like a bad thing, but in a lot of instances, it can be a good thing because these people are using that money to pay off, let's say, a loan, or they're high net worth people, or the insurance company. Like it's just another way of risk management to a certain point, right? Or maybe they don't think that the insurance carrier's very reliable. So this was also, again, 2006, 2007. So all these new markets were emerging to try to diversify some of this risk. I don't know how big any of these really got, to be honest. I know obviously reinsurance is a little bit different, but the problems are still there. Yep. So I'm not exactly sure these are solving any of these things yet, but I think it was a first crack. But I do think there's a massive opportunity in how we look at this. Like I mentioned, the pension shortfall risk. I mean, that's just coming. It's like, that is just like a very real, real thing that's like on the horizon. And from my recollection, the only Stanley Druckenmiller is one of the only people I read about who was like actively talking about it. I don't hear much else, to be honest.
Yep. And you also describe reverse equity transactions sort of as a way for an individual to extract equity from an asset without using credit, but it's sort of taking advantage of longer life expectancy. So could you sort of explain how that works?
Of course. So again, at the time it was all about home equity loans, right? So tapping your home for equity based on credit. But the way I was looking at this is could you have a mortgage? So there's a cheesy thing called reverse mortgages where, a lot of these things start as like, I don't know, ways for like very small time, maybe, I don't know, but some of them like take advantage of old people and they'll like take equity of their house or whatever. And that's sort of how they start. But the basic principle, that was like the first version. I think that may have been like the 70s or something. But then this sort of like 3.0 version came, which was, it's not an individual person, but like you have swaths of homes now, and people are just getting older. Can they actually remove equity out of their house in what's called a reverse equity transaction? So they're almost getting bought out of their house, but they can live there. It's kind of a strange thing. Like people will continue to pay their mortgage payments, and when they pass away, their house, like everything it just goes to the investor. So it's like a weird way where people can cash out but not have to give up their house. And so it's almost a cousin to renting. And so what you're seeing now, what's funny is that a lot of this stuff back then seemed so weird, but now, if you've seen how things have played out for the last decade, I think, was it Apollo or Blackstone's like one of the biggest residential landlords in the United States. So it's almost exactly what's happened in a lot of ways. Like so many things have panned out in this way for a variety of reasons. And after the credit crisis, so much has changed. But the basic idea of this is that, like the way we look at equity and home ownership needs to change also based off like there's another variable here, and that's our age and how long we're going to live. And so, you're like the cash flows may not match up if you're an individual and you're retired or whatever, and you've got this mortgage on your back. So can you tap that equity but still have to, not have to give up your house? The only thing you're really giving up is essentially not leaving your home to a loved one, but you're leaving it to an investor who's allowed you to live there, to no change to your lifestyle, who's taking over the debt obligations.
Wow. It's crazy.
Yeah. And so to be honest, and back then they were mortgage-backed securities, and they were reverse mortgage-backed securities. So it's really crazy. But again, it's even wilder to me that, like, again, one of these big private equity firms is the biggest landlord in the United States.
Mm-hmm. Yep. Yeah, because it is crazy, because when you think about it, that was sort of when, all the crazy housing products came in. It's almost, in a way, like in hindsight, sort of not surprising, but at the same time, still mind blowing.
Oh yeah, no, there were so many things that were being like, so the problem is, I think this is the problem with all technologies and all innovation. It's like we get super excited about it and we like go nuts about it, and then it dies down, and then like maybe 10 years after that it comes back in a useful way. You know what I mean? It's like, we need to have our like, oh my, like kid in a candy store moment. Like derivatives are a great example, trying to securitize everything. Mm-hmm. But I do think now that, okay, maybe I think some of these things are a little bit crazy, but if you really look at things like, how can we look at water in a different way, right? So one of the big sort of theses I have always had is, or thoughts about it, it's like, we don't treat water with any respect because we all think it's free. Yep. Do you know what I mean? Like, if you put a value on it, I feel like it'd be treated better. It's like corporations just dump waste into rivers because it's free. One of the best things, like someone told me, was that, Coca-Cola and some of these companies, they suck all the water, especially in places like India, right? Suck it from all the farmers right underneath their farms. They're creating drought everywhere. They dump sugar and color into it and sell it back as thumbs up. It's like, it's ridiculous. It's really ridiculous, right? Because their main ingredient is essentially free. And how does that make any sense? Mm-hmm. It's like, literally, it's completely insane, right? Like, if your absolute base material of your product is 100% free, like, how that just doesn't make any sense. And like in a regular situation, that's exactly what's happening. So like, there should be a massive, I don't know about massive, but there should be some cost to it. If there's a market for it, maybe that's not the answer. This is a back of the envelope thing, but if there's some sort of, if there's some sort of value to it, like maybe that things like that shouldn't happen, and there are more protective measures taken for I'm just saying, farmers in India or whomever. Yep. But I think right now, if you think it's free, people don't treat it with any respect.
Yep. And we'll get to the water theme in just a bit, but first, but I wanted to cover the second theme in your book, which was trading fish. And so as far as I know, there aren't any very commonly traded, say, fish futures or anything. So how do you actually so number one, what was the thesis for fish? Is it along the same, longer life expectancy, demographic kind of change, or
so it's, oh, sorry, go ahead.
And again, how do you actually think about trade construction for another extremely esoteric market?
So a lot of these things actually looked at putting together my own futures contracts. So wow. for this one, it always fascinated me, and to be honest, even now, and to tie this sort of what we're doing now in the biotech world, even there's certain elements of, let's say, there's certain ingredients, let's say, or that impact every product in biotechnology. Or let's say there's certain ingredients that are a huge bottleneck for lab grown meat, for example. So the same thing is with tuna in this case. Like, it's just a supply and demand thing, right? So you've got tuna fish that can sell for $500,000 because we're literally overfishing them. I think somewhere I read that there's more sushi restaurants in New York City than there are pizzerias now, right? So
Wow.
you've got like this massive boom in appetite for, for fish, for seafood, for protein generally speaking, but also for fish, especially tuna. And that creates this massive problem for like both like an environmental perspective, because we're like literally we've crushed the oceans, and that goes back to sort of the water theme, which is we have no respect for it because we sort of just feel like it's free, and then two, it creates a problem in terms of just like price volatility, right? So I think markets can be sort of a solution for some of these things, where like if they're naturally priced, I think it could, again, it's just so interesting to have this conversation so many years after that book came together, because now when I go into Netflix, there's so many documentaries about how we've like destroyed the oceans and the water and all of this stuff, other stuff. But it's interesting because back then, like, I don't really think people were thinking about it like that, but it can create some like price stability. And not only that, even if the prices are really high, in a weird way, that spurs innovation for alternatives, right? So
Yep.
that my sort of rationale there wasn't really about, it's not really about capturing a it's both, right? When there's an opportunity to make a profit, that's like a good thing, right? So when oil prices are really skyrocketing high, what happens? You see innovation in EV, right? So
Exactly.
like people look at everything too like in a very binary way, but that's not the correct approach, right? So if all of a sudden your spicy crunchy tuna roll is like $45, you're not going to get it.
Yep.
You're going to be like, screw this. Or what's the alternative? Maybe the alternative is a $20 lab grown spicy crunchy tuna roll.
Mm-hmm.
You know what I mean? And maybe you thought that was gross before, but maybe this is actually the right thing to do. And maybe that $25 crunchy spicy tuna roll will be $5 in 5 years. And we didn't have to destroy our ecosystem or oceans to get it onto your plate. So the basic thesis of all these things is that if things are priced according to the mania, then it'll also foster like an alternative. And now sitting here, like, I didn't know I'd end up running a biotech company, but like as a in the world of synthetic biology, that's exactly what's happening, right? So you've got lab grown meat, lab grown, there's lab grown honey that people are working on, lab grown palm oil, lab grown, whatever. We work on an agricultural focus, but it's all about really alternatives to things, and all you need is sort of some sort of catalyst, and that catalyst could be, again, $45 crunchy spicy tuna roll for that lab grown fish to look a lot more appealing.
Yep. And I know it's interesting when you talk about it, because in a way, usually what's happened with stuff like oil is when prices go high, drilling tends to go up. But as you talk, do you think the dynamic for fishing would be different? Because if you overfish, if you end up overfishing, you can't exactly, there's actually no incentive to sort of overfish the overfishing and increase the supply of fish, increase the supply of fish, like supply to the market, right?
Yeah, no. So okay, when oil prices go up, there's more drilling for sure.
Yep.
But to a certain point, you also get a race to find an alternative to it.
That's true. Yep.
The biggest thing that crushed, I think, the sort of the clean energy. When oil prices crash, everyone's like, forget it. You know what I mean? Let's go back to gas. It's so much better. So, these things have both. They're sort of bifurcated in that sense. And I think the same thing is with seafood, right? So, I was watching, I can't remember what documentary, it was one of these kind of cooking shows or whatever. But what was great about it was that they were talking about eating meat in the future. And actually Aanika was on this on a series, a David Chang Hulu show. Aanika Bio was featured on one of the episodes,
Mm-hmm.
but on another one, they were talking about camel meat, for example, and like eating meat as a scarcity. So instead of eating meat every day, maybe we'll go to eating meat once a week.
Yep.
And maybe it's more expensive, right? But it'll be like a delicacy. So, to your point, okay, maybe people overfish or maybe it costs more, but then naturally the balance of that is we eat it like once a week. Or it becomes a real, again, like it's expensive, but it's a rarity.
Mm-hmm.
And so
Exactly.
alternatives have to come and fill up around it. And maybe that's not lab grown stuff. Maybe it's like there's an Impossible Burger for tuna. I know I've actually had one that was made of tomatoes. It was amazing.
Wow.
It literally couldn't taste the difference. I thought I was eating an amazing piece of sushi.
Yeah, as you mentioned, the alternatives just seem to pop up. And one other thing that you mentioned was you tried to initially get your own fish futures market created, but so did that end up happening, or how do you actually end up?
No, it's weird. The CME and some of these big exchanges they're really cool, and they're like, if you've got a good idea, and you can usually find a way in. To be honest, well, if you've been in the finance world, right. The real thing comes into liquidity, like how liquid will it be, right? And who's going to make a market in it? And so, crypto even. I remember
exactly, because that was supposed to be my next question. So who would actually take like the other side of this trade?
No, exactly. So it's funny because now I feel like now things have changed a lot.
Mm-hmm.
So even back then, like crypto, I first came across crypto not as it is now, but it was almost a peer-to-peer money transfer mechanism where the pitch. So somebody came to us, was like, "Can you make markets in this?" And I won't mention what the token was or whatever, but like it had nothing to do with like owning a coin or the coin going up in value. Like this was 2010, I think, or no, maybe like 2012. But it's way before all of this craziness. And the pitch was you can just get money from A to B really fast. It's like, okay, well that makes sense. And then the other application was you can settle a contract really quickly. So given that I'm in this like OTC space where settling contracts is like a week-long endeavor, and it's like highly, there's ISDAs between the banks, and with the banks, there's all this frictional cost and friction and brain damage just to do a trade. The concept of a smart contract that could instantly settle something complicated was like very fascinating. And so we spent a ton of time looking at this protocol, literally purely on the fact that this could be a way to launch, to settle these complex contracts. And if you could do that, then maybe you could get more people to answer your question, to take the other side of these weird trades.
Yep.
Right. So I don't need to get CME on board or whatever. And find, like, I don't need a retail investor to take the other side. I can just find like-minded people who want some kind of fringe exposure to stuff. And then the frictional cost in the middle would go down, and the headache where we could just settle through smart contracts, and that would bolster these markets. But again, it took, to my earlier point, it took literally 10 years or 8 years or whatever for these markets to get to the point where they are now. So now when you hear about like yield farming, which is just really lending, like now might be the time to explore all of this stuff. But back then everything was so new.
Yep. Yep. It's insane because, as you mentioned at the start, pretty crazy that, you could actually get the CME to list none of these products. And I love the comparison to smart contracts. And, moving on, we're talking about blue, gold, or water. So could you talk a little bit about the case for water, but also, you mentioned the politics of water. So could you actually talk about, how politics and geopolitics plays a role? Because, people typically associate stuff like politics with something like oil, one bad thing happens in the Middle East, all of a sudden oil spikes. But here we've got. So could you explain, how exactly geopolitics plays a role in the supply and demand of water?
Yeah, I mean, I mean, it's just like oil, right? I mean, think about how vital water is to our daily needs, right? It's funny because we don't think about it, I don't think. And what is that? You look at any river or look at any body of water, it's like there are multiple countries touching it or multiple regions controlling different aspects of it, right? So, is it creating electricity or whatever? Is it being diverted for, agricultural irrigation, or how is it being diverted, right? There's so many, water touches on so many different things. And, one of the things I find the most interesting, and again, this isn't geopolitical, but it's super important to think about, which is how does our water even affect our food system, right? So you've got, I'm sure you've read or all these in the US too, we've got a lot of these outbreaks of E. coli and from romaine lettuce. And things like outbreaks cost, the country billions of dollars a year, impacts, 50 million people a year, a huge problem. But the issue is that you've got water running through, you've got runoff from like slaughterhouses, right? And these big industrial farming operations, and then flowing into, farms like romaine lettuce farms, where our food products get washed and then packaged. And so you get things like E. coli or salmonella or whatever packed in there, and people get sick. So that very small sort of, very,
Dynamic, yeah.
Yeah, that important but very kind of small thing, just like in one country. Think about that kind of globally, right? Who's in the top of who's in the beginning part of a water stream, and who's at the end? And just how that pans out is very important to think about, because there's so many things. If you talk about food security, not food security in terms of our access to food, but like warfare. You talk about geopolitics, like it's the same with an oil pipeline, right? Where is it running through? But the only difference is we don't really care. The oil is a little bit different, where the purity of the oil is not really coming in question, right? Just the access.
Mm-hmm.
But in water, it's a very difficult thing. And when you tie in climate volatility to this, and this is sort of a real big thesis of mine, which is that what you're going to have is ecosystems that are not built to, like when you've got let's say a warm climate in one place, and let's say a moderate climate or cooler climate in one place. But once those things are turned on each other's heads, you're going to get microbes and things growing in one place that shouldn't be there, right? It's almost like an immune system. You're going to have no natural preparedness for these different things, these different viruses or fungus or bacteria to crop up. And because we all grow, we have a monoculture. So the entire world is basically growing like less than 10 different crops. We could have a massive risk on our hands of famine, or just losing a huge staple of our diet, right? I mean, not to be doom and gloom here, but I think about what are the risks and stuff. And so water touches all of that. So all you need is one water stream to flow through or to irrigate a huge swath of land. And guess what? All of your wheat could be screwed. We all grow the same kind of wheat. I don't know if you know this, but we're in a banana crisis right now.
No, I did not.
We're in a huge banana crisis. To be honest, it's difficult to even get bananas sometimes at the Whole Foods here in New York City. There's a fungus that's been ravaging the banana world for a couple of years now. India, who historically grows those tiny bananas, they've been trying to grow the big US bananas that are in demand. It's a very difficult situation. And if you think about water again, it's the pipeline to everything, right? So if you think of things like contamination and who controls it, it 100% is very important that we need to be the most diligent with our water system. And I don't think that's long-winded way of saying, I don't think that's happening. I think it needs to happen. And I think financial, I'm not going to say regulation, but I'm going to say, certain financial instruments can help potentially price water in a way that we respect and protect it more.
Yeah, I know, it's definitely really interesting. And moving on, were there other I guess esoteric themes that you played when you were a full-time portfolio manager, that aside from these three?
Yeah. I mean, they're like on a shorter term basis. One of the ones I always found interesting were, I used to look at things like, how does, just looking at Japan, some of the big conglomerates in Japan I thought were really interesting. I don't know if you call this esoteric, but sort of the fact that they operate, especially these steel companies, are operating on 1% profit margins. They're like horribly managed. Completely. Japan was always very fascinating to me, because there's so much debt, just left, right, and center, both from the government perspective, on the corporate level, but they seem to be hobbling along. And so, everyone tries to short like JGBs, and that doesn't work. But I'd always look at sort of buying these really cheap credit protections on some of these Japanese companies. That was both esoteric. It had nothing to do with what I've been talking about, but definitely off the beaten path, but super interesting. And again, it's like, it's funny because I think a lot of these things get portrayed in a way, it's like, especially short sellers, as a bad thing. But I think it's good. I think it's great that we have a market where you've got players in finance that there's an ability to call bullshit on things, or to say this could be run better. The fact that you can take the other side of that trade in a variety of different ways is a good thing. I think that can keep companies, can enforce the right decisions at on the corporate level. And again, on the bigger picture, on the environmental level, right? So I mean, again, to go back to water, if we can price it properly, maybe it protects more of our land and protects more of our longevity.
Yep. They're really interesting. And moving on, I wanted to talk a bit about, I guess, general markets, what's going on today, and get some of your thoughts on, off the record, right before this interview, we were discussing sort of the Tesla dynamic, and I think you brought up a really good point. So, you were talking a little bit about the way markets function has sort of changed in a way, because everyone's long almost the same things, and things are going up because everyone's long. And you sort of applied that dynamic to Tesla, and I just wanted to ask you to sort of re-explain that dynamic so that our audience can get it. I thought it was really really important.
Yeah, sure. Look, again, I am not an expert on this at all. I don't own any Tesla stock. I'm as clueless as anyone. So I just want to make sure that that's clear. It's just my point was, and it's not Tesla, it's everything. It's just, we're in this really crazy market time, right? When I graduated college, just to give you an example, we went almost immediately to the credit crisis, and it scarred a lot of people my age in terms of thinking like, oh my God, I didn't even know this was on the table, right? I didn't know printing trillions of dollars was ever even a thing. I didn't know governments could even do this. So now, when we're in this really insane sort of market dynamic, my point was, are things going up? You know what I mean? Is value being created, or is capital moving into things? Essentially, it's a chicken and an egg kind of thing. Because capital is moving into things, so it's going up. Do you know what I mean? Or things going up and attracting more capital.
Yep.
And whether it's Tesla or anything, literally the entire, much of the startup world, much of the private markets, public markets, it's really difficult to tell who's what's driving what. But it doesn't mean that sort of both aren't happening as well, right? So one great side effect of this is that all this capital is going into fueling a lot of innovation. You know what I mean? So I think this is a net good thing. Like, we do talk, obviously the word bubble gets thrown around all the time, but if you think about it, like, so much money is being poured into technology right now. Like, that's good. Even if 3% of any of this works, that's still a massive hit. You know what I mean? Like, it's still like, there's so many shots on goal right now on a variety of different things that whatever comes out of it ultimately in the next, whatever survives the next decade or two will be really meaningful. So, the other point, just directly, specifically to your question about Tesla, was I just found it fascinating that I read the other day that they make so much money off their selling carbon credits. And I thought that was really, really interesting. So yeah, like, it's hard to say if there's a chicken and egg thing in the markets now, but ultimately I think it's good.
Awesome. And so why don't you get to the last part of our podcast, talk a bit about Aanika and sort of the Aanika story. So what exactly what drove you to start Aanika? And, as we were speaking off the record, you sort of said Aanika was a culmination of all the work you've done over the last sort of decade or so. So could you just talk about, number one, the Aanika story, how it got started, what you guys do? And
yeah, sure. So I was working at a fund, and I was making some investments into different things. And one of the things I come across was a TED talk by my co-founder about something called synthetic biology. So basically it's this idea that you could engineer biology, and you didn't need a Pfizer lab to do it. People were doing it in their garage, basically. And that totally blew my mind. And at the same time, one of the things I was involved with was a food product that like invested and sort of co-founded, and we had a recall. And I just sort of on my wormhole sort of Google searches was like, okay, I saw this TED talk and realized that this person was in Brooklyn, and I met her. She's not my co-founder, Ellen, but I went to her basically like, can we solve a simple problem, but it's a big problem, like a traceability issue with biology? And we sort of swirled some ideas around, and what we came up with was this concept that you could use a microbe. The microbes are all over you, they're all over everything, right? It's essentially the biggest data set in the world, and there's microbes on everything. Only 1%, I think, or less is actually bad for you. So generally speaking, they're great. We take probiotics. Microbes basically run the planet in terms of agriculturally speaking and things like that. So could we use them to actually solve a problem where we know where one thing started and where it ended? Traceability problem, the way a barcode can do that. And we figured out a way to use microbial spores, engineered spores, to create to basically contain a little string of information in its DNA, like a little watermark that we could fish out. So if you've got lettuce, for example, to go back to my romaine lettuce problem, if you've got a recall, or if you've got lettuce, we can tag the lettuce, so you can wash it in this water, you can spray it, and then you can go through an entire supply chain. It can be washed, mixed, it can be cooked, it can be heated up, mixed with other bags, and we can take each leaf and figure out where it came from. And the reason that's so great, and I'll tie it into everything else I was saying in a second, the reason that's so important is because it now connects the physical world with the digital world in a sense, right? So we can take a serial number and we can sort of embed it onto a natural product in a way that's never been done before. And we can do it on a microscopic basis, right? On a microscopic level. And so why is that interesting? It's interesting because right now every recall costs like $10 million. It takes 2 months to figure out where it came from. We can do that in like a day. And so think about the pricing of insurance risk, which is how I've spent most of my career. We can now insure, let's say, that supply chain with so much more accuracy, so much better underwriting. That means lower rates to farmers, let's say, lower recall insurance costs, lower probability of payout. It's been my sort of my vision for years of how do we merge these two worlds of markets and sort of financial instruments with the physical world around us. And this can act as a bridge. So, we've done work with some of the biggest diamond companies in the world, with one of the biggest produce associations in the country. We've raised, considerable amount of VC money with some from top VCs like SOSV, Draper Associates, Added Ventures. So we've attracted some real capital. We've built out a huge lab in Brooklyn, attracting great talent, and it's just been a fantastic way to combine all of these experiences I've had.
Yep, awesome. And what exactly makes Aanika's sort of methodology to price insurance or price like the risk relevant to insurance different?
Yeah. So if you think of a food recall, let's say, right?
Mm-hmm.
Okay, or you think of crop insurance or food recall, whatever it is. How do you distinguish two identical products, right? Once something has left the bag, how do you take two leaves of lettuce and figure out who owns who? Like whose policy belongs to who?
Mm-hmm.
Who's covered, who's not covered?
Yep.
It's impossible. Two grains of rice, two coffee beans.
Yeah.
With our tags, we can actually do those things. Or if you think of this ESG story, something that's big that's happening now is non-safety ESG recalls. So, for example, is this sustainable or isn't it? Was this done in a humane way? But how do you validate that? How does a big retailer, have confidence in what they're buying? So the packaging doesn't tell you enough. And a lot of times things are removed from packaging, they're mixed together. And so we can help literally link each of those physical products to the carrier, to the farm, to the batch number.
Yep, absolutely. And before I wrap up the podcast, I wanted to ask you, are there any themes or questions or anything that we haven't covered that you would like to talk about?
No, I think that's it. For me, I think that the two biggest ones are climate volatility, which I think is on everyone's mind now.
Yep.
And I think the pension crisis. Those are the two big ones. I think are.
Yep.
I mean, I don't know if you lump water into there, but those are the big themes for sure.
Absolutely, and it was really interesting this hearing you talk about some of the, I guess, almost unique themes that you explained in more detail in your book, and I had a lot of fun and I really enjoyed it. So thank you so much for being on the podcast, Vishaal. It was fantastic.
Thank you so much, and thanks again for having me.